I'm Dick Berner, and I'm delighted to welcome you to today's NYU Stern Fireside Chat. This is the first one this semester. Our purpose in these chats is to promote a rich dialogue between, or among, I should say, the NYU student, alumni and alumni, and faculty community, and market participants, current and former policymakers, and other thought leaders. Now, the hosts of today's Fireside Chat are the Stern Center for Global Economy and Business, and my colleague Kim Schunholtz, who directs that center, is sitting here, and the Stern Volatility and Risk Institute. The center promotes faculty research that emphasizes the global aspects of modern economies and business, and the Institute promotes interdisciplinary research to assess both financial and non-financial risks. We are especially pleased today to have both students and faculty from all over NYU in addition to Stern. So thanks very much for joining us. Today's program will last about 75 minutes. I'll engage our distinguished guest in a dialogue in the first part, followed by audience Q&A that I will moderate. And we'll finish by 5:45. Please note on the screen that you can submit questions to our guest using your smartphone by going to the website slido.com and entering the code number 3333 in the box labeled Join. Provide your full name because we don't accept anonymous questions. You can also vote on the questions that others have submitted. This will help us judge the issues that are of greatest interest to you. So it's my great pleasure to welcome to Stern Jelena McWilliams, who's chairman of the Federal Deposit Insurance Corporation. A lawyer by training, her career spans private practice, banking, the Fed, Capitol Hill, and now critical leadership in financial regulation and oversight. Jelena is truly a role model for all of us. Please join me in welcoming her to Stern.
These are tough questions. Who's asking these questions?
So again, Jelena, welcome to Stern. Thank you very much for joining us. We are absolutely delighted to have you. And I want to start by, before we dive into a lot of the questions that are up there, I want to talk a little bit about you. So why don't you tell us a little bit about how you came to this job and your passion for the work that you do?
So I am, I would say, an accidental regulator. For those students in the audience, I never set out to be a regulator. I was going to change the world, but not by regulation. I was going to be a war correspondent. I come from the former Yugoslavia, and as you can imagine, being a war correspondent would have been interesting at a certain time in its history. And over time, I basically went from wanting to be an astrophysicist to wanting to be a war correspondent and taking classes in all of these areas. And then actually going to law school after I changed my major from astrophysics at Berkeley to poli-sci and mass communication. And then realizing, this is before the internet really developed, realizing I will be reporting on weather for the next 20 years probably at some KQED station someplace, and I may as well go to law school and be a lawyer. And so I went to law school, went to Berkeley Law, studied law, really became interested at the intersection of finance and law and how law really impacts the world of business. I kicked myself for not actually doing a joint degree at Haas School of Business and Bolt Hall School of Law then, but you know I'm still regretting that. So if you're thinking about a career, getting a joint MBA, JD, phenomenal opportunity if you can afford it. And then really coming to Silicon Valley post 9/11 as a lawyer. And what happened is that the financings basically dried up. And so the United States went from having 450 IPOs annually in 99, 2000, to literally dropping below 100 post 9/11 because people would just not invest money. And so if you were alive and practicing law or business or finance at that time, or banking, you realize that deals just died out. And so I went to work at a law firm at a time when law firms were rescinding offers that they made to students from law school. So you're coming out with, many zeros of student loan debt, and you have to repay that debt. And in a society like ours, you would like to start repaying the debt as soon as possible, and the offers for jobs were just getting rescinded left and right. And so I basically, I like to say I hustled. I got a job at a law firm, and whatever they threw at me, I did. Do you want to study Do you want to work on an IPO for a company that does non-Hodgkin's lymphoma personalized immunotherapy? Sure, I'm your lawyer. Hey, I'm good to go. Non-Hodgkin's lymphoma, I know everything about. I know nothing about. Do you want to work on semiconductor manufacturing offerings? Sure, semiconductors are us. And so I literally hustled. I took every single IPO, every single merger, every single transaction I could work on. I worked long hours. And then over time, I kind of developed this feeling for the intersection of business and how these deals are done and the regulation, right? And at that time, I remember I was in Silicon Valley. This was in the aftermath of Sarbanes-Oxley. And usually we get these big laws and regulations after some crisis happens, and we'll talk about that in a second. But I ended up calling the Securities and Exchange Commission quite often, saying, hey, I have this client that's trying to do something really interesting, and yet we're looking at laws from 1933, 1934, 1940, and how exactly are we going to fit in this into those laws? And so I became really interested at the intersection of regulation and law, and how did law come to be derived from these statutory requirements. And so I wanted to get a job in Washington, D.C., and learn how, people want to learn how sausage is made, people want to learn how to cook. I wanted to learn how laws become, what they are. And so I literally, like a naive little kid, I go to DC and interview with law firms saying, I really want to work here because I'm trying to figure out how this world functions. And I really should have gone to a regulatory agency right away, but I had no connections. I didn't know how you get a job. I didn't know where you apply. And so I got a job at a large law firm in Washington, D.C., and I did securities offerings and mergers and acquisitions against kind of a market investment banking type of law activity. And then one night, after I saw 22 sunrises in my law firm, working on deals, I literally at 4...
And a few sunsets, I can imagine.
This was June of 2005. I went to usajobs.gov, which is a job placement website for jobs in the federal government. And it's a black hole. Like you send your resume in, it goes in, it gets sucked in, and nothing ever happens. You hear you get the notification email, and then nothing happens after that, right? Lo and behold, I did get a response. And I got a call from 2 agencies, and one was Securities and Exchange Commission, and I was very excited about that one. And the other one was the Federal Reserve. And so I'm thinking, I know what the SEC does. I have no idea what the Fed does. Right? So I go and interview for both jobs. And this was at the time when the Securities and Exchange Commission was setting up its division of trading and markets and also its credit rating decision in the aftermath of Sarbanes-Oxley. And so I interviewed, and they were trying to figure out which division would I be the best fit for. And they kind of, it was like a tennis match between different divisions. She would be really good here. No, we could use her here. I'm like, I'm good. I'm not that good, people. I'll take any one of these jobs. And then the Fed did a remarkable thing. I went to interview at the Fed, and this was, I submitted my resume on a Monday. On Wednesday, they called me. On Friday, we had interviews for 6 hours at the Federal Reserve. And Monday morning, they made me a job offer. And I said, I don't know a single corporation in the United States who can make you a job offer this quickly, right? What is it that you do again? I don't care. I'll just take the job offer, right? So I took a job offer walking into the Fed, and the job was in the consumer protection division. And I walked in pretty much not knowing anything about consumer protection and banking. I was a securities lawyer. And I told them that at the interview. They asked me, so Ms. McWilliams, why are you here? Do you know what these laws and regulations are? I'm like, I have no idea, but you called me, so you must be either desperate or they must not be that difficult to learn. And they said that is true. Actually, we don't have a lot of people who have experience in these laws and regulations. This was before Dodd-Frank and before the financial crisis. And so we're happy to train good lawyers. And I'm like, all right, check the box. Let's go on. And so I went to the Fed. This was early 2007. And what I didn't expect was baptism by fire. So the first thing that landed on my desk was, how do we regulate subprime loans? Yeah, thank you for chuckling there. The next thing that landed on my desk was interchange. This was before the Durbin Amendment and all of the changes to Dodd-Frank, if you have studied those. How do we regulate interchange, basically the fees that consumers pay when they use these cards and the relationship between the merchant and the card processor? And so I'm talk about learning quickly. The learning curve was not a curve, it was a wall. So I climbed the wall, and the financial crisis happened, and I was at the Fed, and all of a sudden, a former securities lawyer who was just about learning about consumer protection laws and regulations had to actually learn about liquidity and capital. And I remember sitting in 2008 in the middle of the financial crisis as a staff member of the Federal Reserve Board, literally as a staffer, sitting at the Federal Open Market Committee. And I remember telling myself, you're a little kid who came here from former Yugoslavia with $500 in your pocket. And there's this huge seal of the Federal Reserve in the boardroom. If you ever have a chance to do a public visit to the Fed, they organize tours. And you look at this huge seal, you know what I'm talking about, and the Federal Reserve governors are sitting there, and the Federal Reserve Bank presidents are sitting there, and they're talking about really big issues and the economy collapsing. And I just remember sitting there, just kind of being caught in the greatness, for the lack of, the gravity of the moment that, I'm witnessing all of this, and what's happening with the subprime? Wow, okay. And then that reality check was pretty quick. And so when Dodd-Frank passed, I had an opportunity to go to the United States Senate, and I was really, really curious how they actually drafted Dodd-Frank. I was like, how do you draft a law, right? And it ended up being this big. If you ever look at a Dodd-Frank book, before that, if you look at Sarbanes-Oxley, it was, I want to say, a couple of hundred pages. The Securities Exchange Act, there were less than 100 pages. And then all of a sudden we get a law that's 2,700 pages, covers everything under the sun, right? And so I thought, well, if I have an opportunity to go work in the United States Senate, why not? And so I did. I took a job first at the United States Senate Small Business Committee, and then the Senate Banking Committee. And then from there, I had an opportunity to actually go to a bank and become a general counsel. And I had no interest in that job. I basically, when they came calling, I said, I love my job. I'm actually not really interested in that job. Until my former boss, who I credit with a lot of paths that opened up to me in my life, said, why wouldn't you take a job? He's like, do you know how banks work on the inside? And I said, well, I go to a branch, I peek behind the window and they count the money. He's like, no, you worked at a regulatory agency. You worked as an outside counsel. You worked at a legislative branch. But you have no idea how banks work. Go work at a bank, learn how banks work. And so I did. I took a job at a bank, learned a little bit about how banks work, some banks at least on the inside, and then I received a call to whether or not I would be interested in this job, and I didn't hesitate. I just said yes. They said, you want to think about it? I said, no, yes. I mean, yes, no. Yes, I am interested in the job. No, I don't need to think about it. And that's how it came about.
That's a fascinating journey. The lesson is you keep learning through every step in your career, and I think that's something that our students and our faculty, quite frankly, need to hear. That's certainly been
and I have to tell you, so as you're considering careers and different developments, I think the biggest advice I can give, and who am I to give any advice, right? But if I can give one piece of advice, never be afraid of making a change. Never be afraid of making a change in your career. And here's why. I thought my being a securities lawyer, so long as there is the Wall Street and there are investment banks and there are companies that go public, as an investment banking lawyer, I knew I would have a job, right? So it's an insurance policy. It's almost like literally buying an insurance policy. I knew if I do securities deals and mergers and acquisitions of public companies, I will have a job. And so when I as a 6-year lawyer at a law firm, at a couple of reputable law firms, I decided I'm going to go now work at the Federal Reserve on what? On consumer protection. I had to do some soul searching. Am I throwing away my insurance policy? Because I knew that even after a couple of years at the Fed, I lose the cutting edge of being the securities lawyer. And in the end, I learned something new. And then when I took a job from the Fed, and by the way, I took a job from a law firm to go to the Fed that came with a 47% pay cut. 47% pay cut. And I have to tell you, it wasn't pretty. And then when I took a job to go from the Federal Reserve to the Senate Banking Committee for Senate Small Business and then Banking Committee, I took another 25% pay cut. And I remember my parents are here with me now in the United States, and my dad was born in 1925 in Montenegro, tiny little village in Montenegro. And if you can find Montenegro on a map, and if you can find this little village on the map, all the better. But it's not, it's this big. And I remember coming to my dad who, I grew up basically was born in a kingdom, fought fascism and Nazism in World War II, and then lived under communism, and then quasi-socialism, and then I brought him to the United States. And I'm trying to tell him, Dad, these are great jobs. 47% pay cut, great job. Dad, it's phenomenal, only in America. Dad, 25% pay cut, phenomenal job. I mean, this is like, for my career, wonderful. I'm going to learn so much. And he looked at my mom and he said, it's all your fault. So don't be afraid to change careers, because just invest all of yourself in what it is that you're doing. But change is not good, is not bad, is not good. Change is good. Don't be afraid of change. And then just, go for it like it's the only thing out there. Learn everything you can. If there's a wall to climb, climb it.
So with all that energy and experience, tell us about your vision for the FDIC, how you're working with other regulators to achieve it, and what you're doing to improve the agency.
So that's a lot of good questions in one. So I came to the FDIC, and it's a venerable agency, established in 1933 following another crisis. And what's really interesting about the deposit insurance and the idea of the FDIC, if you study the regulatory history of how these agencies came about, there was the OCC, the Office of the Currency Controller, in 1865, in the aftermath of Civil War, because we need a stable currency for the United States. And if every state issued its own currency, and you were trying to grow cotton in Virginia and trying to buy cotton products or sell cotton to make cotton products in New York, that $1 from a Virginia bank was not $1 in New York. It was probably 85 cents to 90 cents in New York. And further you went south, that $1 lost its value. Further you got moved from New York, right? So there's the Office of the Comptroller of the Currency, 1865. And then we had a couple of financial crises, one of which, literally a man named J.P. Morgan bailed out the financial system. And question came about, well, do we want these private individuals to bail out our banking system, financial system in the United States? And so you got the Federal Reserve in 1913. And during the debate about the Federal Reserve, if you read the legislative, so there are two things you should do. And well, one thing you should do, one thing you shouldn't do. Never watch C-SPAN, unless you want to go to sleep. Because I have to tell you, you want snippets from the Senate debate, you don't want the whole debate, because it's not that interesting, right? The thing you do want to do is, if you ever get a chance, and especially if you're curious about history, read the legislative debate on the floor about some of these things being created, like the FDIC or the Federal Reserve, and you learn a ton. You learn, how we came with 12 Federal Reserve districts and how we came with the notion of deposit insurance. And in 1913, as they were debating the Federal Reserve, they didn't really have, they tried to get a deposit insurance formula in there somehow. They didn't know how to fund it, and they didn't know how the public would respond to it. So it actually took another crisis for the FDIC to be created. So as I assume the leadership, I'm looking at the agency that's about 85, 86 years old. And our mission over time has changed. We both regulate banks, and we also protect depositors in banks when the bank fails. But then we, over time, got a resolution authority. We resolve banks. And then over time, we also got the so-called backup supervisory authority, right? So this is what I like to do with the OCC and the Federal Reserve. We have the backup supervisory authority. We have two different authorities. One Congress gave us in Dodd-Frank, and one we had before Dodd-Frank. And so it allows us, if we don't think that the Fed or the OCC are doing a good job supervising banks, to show up and say, you know what, we actually disagree with you. So we're going to go in and supervise this bank or assign a different rating to this bank through this backup supervisory authority, because, by the way, we have the deposit assessment on that bank. That bank has to pay deposit assessment fees for the insurance. And as a result of that, we would like the bank to be rated in a way that would provide more money for the deposit insurance fund. So we have that authority. So when you ask me how am I working with the other regulators, very well, because they all know we have the backup authority, right? And so, but other than that, we actually get along. And I know, as a former Fed staffer, I know a lot of people at the Fed. So it's when I talk to Randy Quarles, I'm like, Randy, that's a great idea. Should I call such and such and tell them that? He's like, no, please don't call my people. I'll call my people. But it helps if you know the staff and you have worked there. And so my vision for the FDIC is basically to move the agency in terms of bank supervision into the next stage where there's more digital banking and digital delivery. We can't be blind to innovation. We have to adjust. Our examiners still go and examine banks by looking at reams of paper. They literally go and look at reams of paper, and all of that should be digitized and uploaded, and we need to change, how we are looking and supervising these banks, and we can get into more depth on that. In terms of resolution, these banks are becoming more complex. Even the banks that used to be more simple are more complex by the very nature of the consolidation in the industry. We have fewer banks. Annually, in I call it peacetime. In peacetime, we have about 200 bank mergers. So as I look at the FDIC and the number of banks we supervise, and we supervise the largest number of banks, they're smaller, but the largest number, during my 5 years, and I have a 5-year tenure, during my 5 years at the FDIC, at 200 mergers a year, we're going to have 1,000 fewer banks by the time I leave. Just think about that in the United States. So we are looking at a number of initiatives, including how can we ensure that the community banking model in the United States perseveres and succeeds, especially in rural communities where there's no other banking presence. Right. We're also looking at how can we improve our resolution mechanisms so that as these banks get more complex, that our knowledge and capabilities grow with it. And then on the deposit insurance side, frankly, we're looking at, are we applying the formulas appropriately? So those are some of the initiatives.
Great. So I want to talk about some of those in some of the other questions I have. For starters, I think you probably agree with me that our banking system is stronger than it was before the crisis. But what do you think is left to do to make the system more resilient? And how should we balance that resilience against making our regulation effective, efficient, appropriately tailored?
It's one question that I think about all the time, in quite frankly, and here's why. The system is definitely better off. There's more capital, there's more liquidity, banks are better regulated. Some of the changes we made are taking effect in a way that even the management at these large banks is saying we're better off, right? They know their business model better. We force them to actually know, the crisis forced them, and then the regulations force them to know their businesses better and to de-risk some parts of the businesses. But what I think about all the time is, so we have multiple layers of capital and leverage and liquidity requirements. And if a real crisis comes upon us again, exactly how is all of that going to work at that point in time? These are multinational players. They quite often function on several continents. We're not supposed to ring fence, but will everybody really not ring fence? Or is there going to be a regulator that's going to say, no, I want the capital and liquidity to stay in my area, like in my jurisdiction? And so the question for me that I think about all the time is, you're making a car, and you just hope that when the moment comes to turn that car on, everything goes smoothly, right? And so that's when we talk about resolution planning, when we talk about capital liquidity requirements. In peacetime, again, all is good. But when that next crisis happens, will that car turn on, and will exactly all the lights come on the way you want them to come on?
Right. So we talk a lot about resilience in our financial institutions, our banks. What about our markets? For example, are you confident that the reforms to money market funds have made those markets more resilient and reduced the chance of a run?
See how good he is? He's asking me a question that should be directed to the Securities and Exchange Commission. And I'll tell you what
I have so much experience that, I want to tap that.
So I remember the 2014 study you guys did, right, when you were at OFR, Office of Financial Research. I know when to stay in my lane, so I'll just say that I hope the SEC did a good job with the reforms, and I will have to defer to them on that question. With respect to the reforms we have implemented on capital and liquidity for banks at the FDIC and other banking regulators, I'm comfortable with where we are right now and the resiliency of the system as a whole.
Okay. Fair enough.
I'm probably getting a call from Jay Clayton right now someplace.
Not to mention the other regulators. Do you think that, we all talk about diversity in our economy and our financial system. It can be beneficial. Do you think that the setup that we have with multiple regulators makes our system, our regulatory architecture, stronger or weaker, and how does that work?
So for the longest time, I thought if you're going to set up a regulatory system, you definitely wouldn't set it up this way, right? You would not set up one regulator to regulate national banks, another regulator to regulate state charter banks that are members of the Federal Reserve System because they bought into the system, and then a third regulator that supervises state charter banks that are not members of the Federal Reserve. You can't even explain this stuff. Like when I go to Europe and actually talk to folks in Europe who are not regulators, just trying to explain how the system came about, this is not how you would build a house, right? But there are some benefits to the system as it is, right? And partly selfishly, I'm like, well, the FDIC, why wouldn't you have the FDIC? We are supposed to provide checks and balances on each other. And here's how. Part of it is the backup supervisory authority, right? So if we disagree with the ratings that the OCC or the Fed are assigning to these banks, and because of the backup supervision, we actually go on joint exams with them, right? We can disagree on the rating and we can challenge them, right? And because we have deposit insurance, we actually have a tool. We have the carrot and the stick as to how we're going to apply the deposit assessments to banks, even if we're not the primary regulator. And because the Fed supervises bank holding companies, through the supervision of the bank holding company, the Fed will have, sight into the national bank and a state charter bank that's not a member of the Federal Reserve System. So it's almost like we're constantly in a checks and balances system with each other. And so, years ago, I would have said, oh, this is crazy. Who would have set up, you wouldn't build a house like this, right? Or at least it wouldn't pass the inspection. But more I think about it, and more that I'm now engaged in a behind-the-scenes work, more I think that it's not as crazy as it may look to an outsider. And we are supposed to, have this constant flow of information and challenges. And I like to call it that we should be constantly dissenting and challenging each other. Dissenting from and challenging each other. And having that level of relationship is crucial, I think, to the health of the system itself.
Right. Gets away from groupthink. So you mentioned innovation and what you want to do for the agency. Let's talk a little bit about that. Obviously, innovation and fintech are changing the business models, changing financial firms. Do you see risks as well as benefits in these developments?
There are absolute risks there. Having said that, it's absolutely necessary that we encourage innovation. And here's why. It's going to happen. It's going to happen anyway. And I remember when I was working in Silicon Valley on with different early stage and startup companies, they're going to innovate, whether or not it's done with banks, by banks, inside banks, or outside of banks, right? And so as I look at innovation that's happening in the financial system in general, I would actually like to bring more of that innovation inside of banks. Partly selfishly, again, because then we can regulate it, we can have a line of sight into what exactly they're doing. But partly also because we benefit from innovation in the system, right? If you can deliver channels of banking products and services to customers that are previously unreachable by banks. We're talking about 20 million Americans who are unbanked. We have a lot of people who, usually low and moderate income communities, who they can't afford their rent. They cannot afford a car payment, but they will for sure pay that cell phone bill, smartphone bill, right? Because this is their eyes to the world and their ear to the world, and this is their world, right? So we have to encourage innovation that's going to allow more people to be a part of the banking system, and for banking just to be better and provide better results. But at the same time, risks are inherent to innovation, right? And so for a regulatory agency, I think it's crucial that we strike that balance between encouraging innovation, not over-regulating it where it's not necessarily, but providing appropriate safety and soundness and consumer protection. And so it's a constant dance, but I would like for us to be in a position, and this is, whenever I say this to our economists, it's blasphemous, but they have gotten used to it by now. But, where we don't have a need for call report data. So banks file call report data. We ask them a ton of questions. They fill out these things, no longer by hand, but nonetheless, they're like long tables of, liquidity and what kind of assets do you have and maturity dates. And they send us this data on a quarterly basis, right? And where we should get is the point of instantaneous transfer where that information is available within, say, 60-minute lag time. I don't know, give it 62 minutes, whatever is appropriate. But where we can actually access the situation and be able to analyze what's happening in those banks, right, not with a 90-day delay, yep, but more instantaneously. So if you want to talk about, looking for financial stability indicators and systemic risk and any spikes here and there, what am I going to do with that information 120 days later, right? It happened 3 months ago.
Exactly.
And so I'm hoping that we can get through innovation to a point where we can have a better approach to accessing data and managing data and the data exchange between the regulators and the banks as well.
So let's talk about innovation in the agency. Tell us what FDiTech is, what you hope, what its goals are, and what you hope to accomplish with that initiative.
So everybody has a lab, so we should have a lab. No, I'm kidding. That's not how we created an innovation lab. FDiTech is an innovation lab at the FDIC. And so when I came to the FDIC, I came to a couple of very interesting conclusions after I spent a couple of months there. One was that innovation is happening, and whether or not we get on board as an agency, it's happening, right? And so we can fight it. We can say, fintech's dirty word. Don't go partner up with a fintech. You know why? Because it's inherently risky. We are a regulator. We don't like risk. You shouldn't like risk, you the bank, and you shouldn't partner up with a fintech. You know what's going to happen? That fintech will then go partner up with a Fed bank or an OCC bank or a non-bank, right? And all of a sudden more lending and more financial activity will happen outside of the banks. And then, you know, you're a former director of OFR. Is the system better off if there's more risk outside of the banks, or are we willing to actually have some risk in the banks that we can regulate, right? And so there's this constant dance of where do you want that risk and how do you want to manage it? And so it became important to me that we create a platform for the exchange of these ideas. And so I met with, I would say, about 24 fintech companies in Silicon Valley and San Francisco. And I asked them 3 questions. The first question was, where did you see a market discrepancy where you thought you can fulfill a need? And they would tell me. And the second question was, why did you think you could deliver and solve that market discrepancy better than companies that have $100 million, $1 billion behind them, right? Some of these big tech companies, and instead you emerged. And then the third question is, how are you partnering up with banks, and what are banks asking from you, and what are you asking from banks, right? And so once I got a sense of how they're doing this, I realized that we can do more to encourage innovation. And so the idea behind FDiTech was to create a platform for the exchange of those ideas, for us to engage in partnerships with companies that are looking to innovate. My ideal world would be a world in which we can basically have an instantaneous exchange of ideas. So when a bank is thinking about partnering with a fintech, that they say, hey, I'm looking to partner with this XYZ fintech company, and how are you looking at this company? And we would have a database, frankly, and because we put them through a process, you know, something that I call the FDIC Good Housekeeping Seal of Approval, where we have actually taken a look at the company, and we were able to do an exam of how these tech companies are looking to offer banking services and team up with banks. And if they satisfy our requirements for safety and soundness and consumer protection, we can give them a green light. And so if a bank calls up and says, hey, I'm looking to team up with XYZ, you know, we can say, oh, XYZ is on our list of FDIC-approved companies or FDIC-scrubbed companies, whatever you want to call it. And so the idea here is to basically modernize the way we look at innovation by allowing banks to partner up and giving them a path and a roadmap, but also to change the way we supervise banks. Our banks are going digital. The delivery channels are more digital. They are looking at customers who expect digital delivery. And our examiners are still examiners, you know, based on the model we have had 20, 30 years ago. And so we have got to bring more artificial intelligence, machine learning, open API, more of the tools, technological tools and innovative tools to the FDIC supervisory model, so that our examiners, that the examiner of the future is going to be a techie. It's going to be a person who actually, you know, knows algorithms and programming and understands different technologies. And so when they go to a bank, and frankly, the question is, do they then need to go to a bank? Will they be able to do everything remotely? And that I don't know yet. We still do on-site exams. I'm trying to preempt one of the questions that was up there. But you know, the examiner of the future is going to look very different than the examiner of right now.
Right. So a related question. We have a regulation on the books, the Community Reinvestment Act. How do we think about that in today's digital world? What should we do to change it?
So we opened up the Community Reinvestment Act regulations. They have been, so the law passed in 1977, Congress passed it in 1977 to make sure that banks were not redlining, and they were serving the communities where they, the law says where they are chartered. And over the years, the regulators have interpreted the definition of where they are chartered not to be a physical chartering location, but where they're taking deposits. So the idea here is, if the banks are taking deposits in certain communities, you know, from name a community, you know, neighborhood in Chicago, they're supposed to lend in that neighborhood in Chicago. And And so over the years, the law has been, the regulations, the law is still as it was, but the regulations were updated in 1995 and not since then. So we have about over 20 years of regulations on the books that have not been updated in terms of how we're looking at where banks are taking deposits. During that time, banks started taking deposits with a snap of a picture, right? They started digital deposit taking, and some of the folks here look too young to even remember there used to be deposit slips that you had to write with your check, and then you had to put both in an envelope, lick the envelope, put it through the window in the, that's how you used to deposit the check. So none of this, right? And so now we have an issue that CRA has not been able to keep up with, which is if you have a customer whose primary address is, say, that neighborhood in Chicago, and that customer travels and has a winter home, summer home, or just travels outside of that area and takes a picture of the check, and you can geocode where that picture of the check was taken to make a remote deposit. Where is the deposit taking area for the purposes of the CRA, right? And it's both like an interesting philosophical question, but it's a technological question, and it's a question that the current CRA framework cannot answer. So the banks will take that deposit generally to be taken where the primary address of the customer is. Never mind that customer is, maybe temporarily living someplace else. So we opened up, we proposed a new framework in December. We're looking at it. Today we extended the comment period by another 30 days because we're trying to get information from the banks and from the consumer and community groups, exactly how should we be looking at this. And I think there's an opportunity to modernize it and take a look at where can we improve the act to address some of these idiosyncrasies.
Great.
Yeah.
So the FDIC started, and you mentioned it, with deposit insurance. Let's talk about the intersection of deposit insurance with what's going on in technology and banks. Vero Money, an online mobile bank, was approved very recently for deposit insurance. What did they have to do to earn that?
So we put like a 10-foot pole, and we said if they can climb, I'm kidding. That would be actually funny, though. They had to.
I'm not sure he couldn't do that.
They had to meet the statutory and regulatory requirements. That's, people say, and I can't speak of any particular application specifically, but I'll tell you this. It's easy for us to approve I call it a vanilla application for deposit insurance. If you're a good old bank, community bank, and you're going to, raise $10 million, $15 million of capital, and you're going to have 3 branches, and you're going to make mortgages, and you'll do credit card lending and take deposits, check the box. Good management, check the box.
Smells like a bank.
We're good. If you're, I like to call it a vanilla bank with sprinklers, you're going to be, a good old traditional community bank. You're going to do all of previously mentioned things, and then you're going to do a little bit of digital offerings. We can take the sprinkles. Check the box. We can probably approve you pretty quickly. If you're not a vanilla bank, so this is not Baskin Robbins, people. You walk in and you're confused with the flavors, right? If you're not a vanilla bank, it's not so clear how the statutory requirements that Congress gave us can be applied to that not traditional vanilla, even vanilla with sprinklers bank, right? And so as we're getting more of these digital banks that, again, how are we looking at the CRA assessment areas? When you're just a digital bank, right? Your depositors live everywhere. Where are you going to provide CRA credit? And so as we're looking at all of that, we have a profitability requirement. It's a statutory requirement. It has to show that if there's a parent, that the parent is profitable. So why? Because deposits are considered to be a source of cheap funding. And so you don't want the money to be coming at the insured depository level, where the United States government stands behind the deposit insurance, and then fund the parent. You want the parent to be a source of strength for the depository institution. And so as you look at all of these things with some of these tech companies, that are looking to enter the world of banking, it's not that clear. So it's taking a little bit longer, but we are tediously working on the application process. We have changed how we look at the applications. We can't change the requirements, but we can make our process more effective, and we did. And so, they were able to meet the requirements, and kudos to them, they got approved.
So you charge fees because, after all, deposit insurance is insurance.
Yes.
So you charge a premium. Are those fees actuarially fair? Or should they be fair?
Oh, that's a loaded question. Fair. What's fair? So here's how we look. I don't know that I can answer that question with utmost certainty, but this is how we look at it. Congress gave us a mandate. So the Deposit Insurance Fund stands behind deposit insurance. And interestingly enough, and I tell Europeans this all the time, they're looking to pre-fund. In Europe, the deposit insurance is kind of ad hoc, and they're trying to create a unified scheme for the European marketplace that would provide, deposit insurance, and then you have a fight of the countries, et cetera, et cetera. It's a common thing, right? I like to tell people there that, as they look to the United States as an example of the Deposit Insurance Authority, FDIC, and the United States as the country, that our system has evolved over time. And in 2009, we basically had zero money in the DIF, Deposit Insurance Fund. The fund went bankrupt, people. And so we had to impose a surcharge on banks. We had a choice back then. No, we got to be honest about things, right? We had to impose. We had a choice of two things. One is go to Treasury at the time and ask for a line of credit. I wasn't there, so I'm glad. I like to be the chairman during the good times. And I take the head off to my predecessors on making the tough decisions. We could have gone to Treasury to ask for a line of credit to fund the Deposit Insurance Fund, or the agency could have done what it did, which was impose a surcharge on banks. They had to prepay into the Deposit Insurance Fund. Probably the worst time for their balance sheets too. Right. But they also understood the value of the deposit insurance behind them. They prepaid into the system. And so the fund was, the DIF was funded again, and now it's at the healthiest level. It's over $110 billion. And we're done with, we had a congressional mandate that when the DIF reaches 1.35% of the deposit, of the total assets that are insured, that we would pay back the part of the surcharge to small banks, and we're almost done with that. And so the way it works is that, we have a cap. We are supposed to reach 2%. Yep. It's a statutory cap for the DIF of the insured assets, and we're at 1.41. It's a slow growth, but it's a growth nonetheless. And we have a large bank formula. We have a small bank formula. For the large bank formula, we look at the component ratings of the CAMELS, overall rating, and we assign different values to different ratings. And so a more risky bank gets a higher premium that they have to pay. And this was not a good thing. This was, they pay more, but it's good for the fund, but they're a riskier bank.
It's good practice.
So yes, so it's risk-based insurance. And so if there are economists and researchers in the audience, we just issued a paper on the history of risk-based insurance and how we came about some of these formulas. And we constantly revisit. When I joined the FDIC, I asked, are we applying our assessments appropriately? Should we be changing the formulas? So our economists are kind of searching through our database of failed bank data to see exactly where we should be and how the formulas have worked in the past. And when they're done with that work, we'll take a look at the formulas and see if we need to adjust.
Good. Resolution. Let's talk a little bit about that.
Are there any easier questions up there?
Well, I'm drawing some of them from up there because
right.
I know what they are. But let's talk about the resolution regime for large, complex firms, which is a favorite subject I know. How can we strengthen the credibility of the government's commitment not to bail these folks out when they get into trouble? So there are two things I don't want to do. I hope never have to do. So in Title II of Dodd-Frank, Title II is a title that gave the FDIC a ton of new authorities. So by all means, I should love it because, I'm the FDIC chairman and now I have all of these new authorities, and it's who doesn't like more power, right? Thank you. But I hope never have to use. I hope never to have to use that title. Here's why. That title is called Orderly Liquidation Authority, and the statute, the United States law, requires the FDIC to resolve banks first through bankruptcy. So a bank, no matter how large, is supposed to be put through bankruptcy, right? If bankruptcy doesn't work, that is when the large bank would go to Title II resolution, and it's Title II of Dodd-Frank resolution, and through the Order Liquidation Authority and the so-called Order Liquidation Fund. And the Order Liquidation Fund is a line of funding that the Treasury Department would provide to basically provide financing for the bridge bank in the resolution scenario of a very large bank. And so I'm hoping that I would never, ever, ever, during my tenure at the FDIC or any future chairman, I wouldn't want this upon any future chairman, to be in a position where they have to place a call to the Secretary of the Treasury to ask them to
commence the funding for the order liquidation fund. Now, this money would be repaid back. It's supposed to be based on the 90% of the fair market value of the assets of the bank at that time. So it's all statutorily spelled out, how much money the Treasury is supposed to put behind this, and then we would take, the FDIC would take probably a decade dissolving the assets, remaining assets, and working through the creditors and different liens to return money back to the Treasury. But it's something that I hope we never have to utilize. So then on the other side of that, what can we do to strengthen banks so that we never have to utilize that? So we have put banks through, I would say, enhanced planning for bankruptcy. And so there are two types of documents they have to submit to us. One is the so-called IDI plan, Insured Depository Institution Plan, which is the resolution plan, which is the bank telling us how they would be resolved. And this would be both through the bankruptcy and the FDI Act. So there are two different mechanisms we can use before we ever come to the order liquidation. And then we also have the so-called Title II plans, which is how would we resolve a bank, a very large bank. And so those requirements apply to the GSIBs, Global Systemically Important Banks, and then also to some regional banks as well. As some people know, some people don't know, but the TLAC, the total loss absorbing debt, the capacity, and the debt that the banks would issue to get TLAC funding does not apply to regional banks. And this is one of the things that has been explored in numerous studies as to should we apply TLAC to regional banks or not. And it's something we're looking at. But the way the TLAC works is that you want to apply TLAC at a holding company for the very large systemically important bank, because you want the holding company, again, to provide the source of strength for the insured depository. For even very large regional banks, 90+% of the activity is done at the bank itself, at the IDI, Insured Depository. So if that Insured Depository were to issue TLAC, it's not clear exactly what it would go to protect, right? Because the TLAC here, the holding company is supposed to protect the insured depository, but if the TLAC is issued at the IDI level, so those are issues we're exploring to see exactly how that would work in resolution and if anything should be done on that question.
All right. Well, one of those plans, referred to as living wills,
yes,
that was aimed at, in part, addressing the organizational structure of some of these complex institutions. Do you find that it's made these institutions less complicated, less complex?
Yes, and here's why. So there's a requirement we have. It's called the 165. If there are any nerds, any legal nerds in the audience, you'll like this. It's called 165D plan. It refers to the section in Dodd-Frank, section 165D. And so it's called the living wills because we're supposed to think about how we resolve these entities. But then if you called it a will, we thought everybody would think the bank is really in a bad shape. So it's a living will, right? It's like a living trust. Thank you for understanding the parody of that. And so we asked them to tell us how they would be resolved, but you can't resolve yourself if you don't know where all of your assets and liabilities are. And I'll tell you something I've learned when I went to work for a bank. Even not very complex banks, when you ask for how many different, I was a general counsel, so the first thing you want to know, where are your liabilities? Where do I need to know? What laws do I need to know? So I said, give me an org chart. So they gave me an org chart, and I'm like, why do we have a sub in, even forgot where the sub was. I'm like, this is a regional bank. It doesn't have an international footprint. Oh, it was for a syndicated loan, for a single syndicated loan that the bank was a participant, not even the leading entity. They had to create a separate entity in this org chart that was now governed by the laws of another state. I said, kill that thing. I can't think of the laws of that state, and I forgot what state was in question. So these banks, they're complex, they're large, and if you have to create a separate entity for a purpose of a single loan, you can imagine that some of them had a ton of entities, right? And so you have seen the CEOs of these very large banks actually say that the living will process has made them take a serious look at their legal entities, and we have a requirement that's called legal entity rationalization. We basically ask them, why do you need all of these legal entities? And we're talking about some of these banks having thousands of subsidiaries, right? And I won't tell you which CEO, but you can probably guess it. I had a conversation with one of the very large bank CEOs, and we were talking about the living will process and what are we focusing on for the next round of the living wills. And I looked at him and I said, it's always a him, right? And I said, hey, but at least now you know how many subs you have. And he says, true. Actually, that was very helpful. So I do think people found value. People who are managing these organizations found value. And over time, if you take a look, and this is really interesting, as a former securities lawyer, I found this very, very interesting. If you take a look at their public filings, if you look at the 10Ks and Qs, they have these large banks, and I'm talking about the GSIBs, global systemically important banks. They have over time simplified their structures, I think, quite significantly, and in some cases as much as they could, while still maintaining a large footprint. So you had banks that shrunk from 150 countries down to 100, right? Because they didn't need to be present. Again, if you have a single syndicated loan, why are you in XYZ country, right? And so over time, I think they have taken a serious look because they have to justify having such a broad footprint. And I told another large bank CEO, I said, I like art, but I don't want your org chart to look like a Jackson Pollock painting, okay? Can you go more with like a Renaissance, like Monet? Can I actually understand where the lines are going and what it is, right? And it was just a slight jab at, don't be so complex that you don't know what's going on. And I think the living will process has helped there.
Great. So speaking of challenges, can you tell us about some of the challenges in arranging the sale of a failing or failed bank to another institution? When you have to do that?
Well, you don't like to do that, but if it happens, and so that's very clear, in peacetime, good economy times, we usually have 5 to 7 bank failures a year. And so what happens in those cases is that you before the bank even comes to the failure stage, you monitor the bank. You know where the capital is, you know where the liquidity is. And at some point, when the bank becomes undercapitalized, you put the bank on the problem bank list, and you just watch it. And right now, we have about 51 banks on the problem bank list, which is the lowest number in over a decade. And you monitor this bank, which means daily.
And they all know it.
Oh, yeah. No, well, if they know it, we have real problems. They know it. The management knows it, and they usually try to get a capital infusion. And they try to, if it's capital issue, they try to bring capital to the bank, hopefully in a responsible way. If it's a liquidity issue, they try to figure out how to provide more liquidity. And so we will monitor the bank on the problem bank list for some time. And it happens that they bounce back and forth. They get a capital infusion. There's an investor who's willing to put in more capital, and they're like, hey, here, I'll give you $1 million, and for a small bank, $1 million is like a lifeline. And so we will monitor that, and maybe they get off the problem bank list, and we're fine. If they don't, and we're seeing the capital decline, we need to preserve enough capital so that we can have a good resolution, meaning there should be some assets there, right? But when we're in this stage, we first try to sell the bank on an open bank basis, meaning the bank is still open. We want to sell the bank, lock, stock, and barrel, assets, liabilities, everything. We need a buyer, right? And so we usually then approach about 10, if there are 10 available, potential bidders on this bank that are in that vicinity, that have a similar geographic footprint, that have a similar model, that would be good managers of this entity. You want a good management team. You want somebody who actually has an interest in this geographic area. And we try to sell the bank on an open bank, arrange the sale on an open bank basis, right? And that doesn't always work out. And at that point, if it doesn't work out, we're in a closed bank sale, meaning the bank is going to be closed next Friday. We're about a week away. We then open up the bidding process for a closed bank, meaning they get to take what they like, say, they don't want the liabilities, they want the assets. Or they don't want to take uninsured deposits. They just want to take the insured deposits because they know the FDIC stands behind it. But now this bank is in a desperate condition, right? Because it's going to be closed, and we are supposed to sell it. And so we will enter into an agreement with the bidder that, we would, sometimes we enter into a profit and loss agreement, meaning if they agree to take more assets than they would otherwise, and if they end up making money from that, we share in the profit. If they end up losing more money, to entice them to take on the bad assets as well, we will share in the loss as well. So we find ways of kind of arranging the sale, and then we will sell the bank. Usually we will show up Friday. It's always a Friday, I was told. We have people invest and heads show up at the bank and say, nobody touch anything. It's kind of like what you see in the movies. Don't move that box. You're staying overnight. Who are you? Your chief risk officer. You're staying here. You're sleeping on the floor. And the goal is to open up the bank with a new buyer's name on the front and no changes to the depositors Monday morning. And so that's how it works. It's an interesting process. It happens. We're actually very good at doing it with smaller banks. We had experience with over 500 small banks during the financial crisis. So if we're not good by now, we never will be. But it's a relatively smooth process, even with a large number of failures we have had during the financial crisis.
Absolutely. I'm going to turn to some of the questions we're getting from the audience. We've covered some, but and they're not the easy ones either, necessarily. We talked about deposit insurance before, and you mentioned it was risk-based, and you have a statutory requirement to have a certain amount in the deposit insurance fund. It's $110 billion now. Is that enough to cover almost $8 trillion of insured deposits?
So you're assuming everybody fails at the same time?
Well, that's why I'm asking. I'm taking.
Who asked this question? Doomsday prepper. It's not enough to cover if every single bank failed, right?
Right.
So you are even when you look at the actuary formulas for for people, not everybody is supposed to die on the same day, because if they did, our life insurance premiums would go up enormously. So yeah, it doesn't cover all of it,
right.
But it's based on the historical data we have, looking at the number of banks that failed at the same time, how much it cost the deposit insurance fund. We have the 2% mandate, and so we're comfortable that's the level where, knock on wood, things going well, we should be fine. Now, if everybody fails at the same time, we have a lot more problems than just the financial system has collapsed. That means some kind of a catastrophe has struck the earth.
Right.
Yeah.
Let's talk about, here's a political question. You knew this was
Why
coming.
not?
We're in a
What
political
could go
season.
wrong? Are you people tweeting? No.
We're in a political season right now. How does the way you think about running the FDIC change from one administration to the next? Or does it?
I wouldn't say it changes. We're an independent agency. We have our mandates. I'm not supposed to, I told my dad this is the best job ever. And he said, why? I said, I can't get fired. I pretty much have to steal money to get fired. So the statute provides that I can only be fired for cause. And I don't intend to give anybody a cause to fire me, so I will not steal money or murder anybody. So it's one of those things where you're supposed to maintain the independence of the agency, and I think there is a courteous thing to do when a new administration comes in, which is ask them, do you really want to keep me, or But they can't really fire you. So if you want to continue on as the FDIC chairman, you continue on, and you can continue with your agenda as well.
Sure.
And we have a board, so the board is a 5-member board.
Right.
And
the governance is definitely strong.
it's absolutely strong, and again, it's the best job ever. I can basically not get fired.
How about looking back at regulation? We repealed Glass-Steagall a while ago. Do you think that was a mistake?
Oh, he said all of these loaded questions. I have to testify before Congress. They pull up stuff like this, and then they ask me, well, when you talked to Dick Burr, you said that. So it was a repeal. So if you want to get into the nuances, I forgot it was Section 26 or something like that of Glass-Steagall that got repealed, not all of it. I don't know if it was a mistake or not. It's up to Congress to decide. We certainly have put in protocols and regulations in place to ensure that things that were of concern to us for safety and soundness and financial stability and systemic risk are adequately in place to protect the system.
Right. So speaking of those threats, what do you think the biggest threat to the financial system and to financial services industry is today?
So it depends on which segment of the industry you're looking at. I think for the largest banks, it's a crippling cyber breach that just locks them up. And we're talking about sophisticated, players hacking into the system and into the backup systems. You always tell them keep the systems on 2 separate servers just in case. But a lot of these large banks have actually played out the scenarios. What happens if they have a bad actor in the system and it basically wipes out their system, and all of a sudden, you're a large bank and you can't communicate even within your branches, let alone international counterparts. So that's something I think for a large bank that's probably one of the biggest concerns, and frankly for the FDIC as well. How would you handle a resolution of a bank that suffered a massive cyber breach and cannot get back up? For small banks, I think the issue is a little bit different. For small banks, the cybersecurity is still an issue, right? But it's presumably limited in scope by the size and the complexity of the bank, which they're small and not complex. But what concerns me there, and I think a big threat to them, is the ability of them to survive in the current framework. And here's why. They get competition from larger banks, from non-banks, from credit unions, from technology companies that are doing the business of banking, right? They get competition from for workforce. Like a lot of these small banks are in rural areas, and there's rural depopulation, right? So they can't hire people. People are leaving those towns. So they're struggling not only to expand the customer base, but struggling to have the right leadership or even hire people for the entry-level jobs. And so I think they have a more of an existential crisis than anything else as a threat to them. A cyber breach to them would be bad, and it could bring a small bank down, but it wouldn't be as bad as it would be for the large bank.
So change is good for some people, but it also can bring problems for other people.
It can, but again, if the banks are willing to kind of adjust to the world that they will live in, and they have to invest in technology. I know it's costly, it affects their bottom line, but for largest banks, because they're so global and interconnected, they have to invest into cybersecurity, and they do. Most of the large banks are heavily investing billions of dollars in IT and cybersecurity and bank secrecy, anti-money laundering systems, and so I'm less concerned there. For small banks, $200,000 is a large number for them. These are banks that have 10 employees, 3 branches.
Yeah.
Well, and so for them to upgrade the system for the latest patch and invest $200,000 versus investing $200,000 in lending in their community, it's a balancing act.
Yeah. Let's see. You got this before. How do you feel about the Volcker rule?
How do I feel?
Should all banks have the same rule? Should it be tailored? Should we just eliminate the Volcker rule? Is it
So I usually
just a bad idea?
Well, see, you're putting me on the spot again. When people ask me, do you like something that's the law? I'm like, it's the law. Whether I like it or not, who cares? My job is to implement the law. It is the law of the land, right? I think even former Chairman Paul Volcker said he didn't think it would have some of the consequences it did. We're making some tweaks to the Volcker rule, and we issued a couple of proposals to change a couple of components of it. But to tell you the truth, most of the changes we made are just kind of a tinkering on the edges. 97% of trading activity is still being handled the same way in our regulatory framework. Wise people in the United States Congress thought that Volcker rule would be a good thing. Again, speaking of how laws are made in Dodd-Frank, and our job is to implement their intent and the rule of law.
Here's a question related to derivatives. And I guess the best way to ask it is, do you think that what we've done in derivatives markets and the institutions who trade in them, have we made improvements in resilience and transparency and openness that really serve the needs of the banking system, the financial system, the end users? Again, a lot of this is in the law, so your job is to implement it, but have we accomplished what we set out to do with derivatives markets?
So I will say this, the pure regulation of derivatives I will leave to the SEC and the CFTC, and because I'm actually friends with both Jay Clayton and Heath Tarbert, I know better than to comment on whether enough has been done, and I'll leave it to their wise counsel. I will tell you from the perspective of the work that we have done at the FDIC vis-a-vis the Volcker rule, I'm comfortable that from the perspective of the insured depository, we have adequate protections in law to make sure that the activities that are taking place in the derivatives market by affiliates of the IDI are not going to unnecessarily impair or impede the safety and soundness of the IDI. So vis-a-vis the insured depository, I'm comfortable where we are. Derivatives market as a whole, I'm probably better off not commenting on the regulations promulgated by the SEC and the CFTC.
What about stress tests? We made a lot of progress. Many people consider them to be one of the outstanding contributions of financial reform. Are there areas for improvement in stress tests? What have we learned from the whole process? Yeah.
So what's interesting? People consider stress testing a part of financial reform. In fact, it is and it isn't, right?
Right.
The company-run stress test is a part of Section 165 of Dodd-Frank. CCAR, what we know now as CCAR, basically came of SCAP, and I forgot what SCAP stood for in 2009. Supervisory Capital, yeah, right, that thing. There are way too many acronyms in DC. And so this test was done, I think, on 33 banks at the time in 2009, and the Federal Reserve just did a kind of a quick test assessing the liquidity and capital availability at these banks. I think originally it was 17, and then it grew to 31 or 33, just to give a confidence to the marketplace who's good and who's not, pass, not pass, fail, and to give confidence to the marketplace that these banks are not going to fail tomorrow, right? And so that morphed into what now became CCAR, and now we have, and when you talk about stress testing, there's CCAR, there's the company-run stress test, then we have liquidity stress testing, and then for the purposes of resolution, we have RLAP and RSEN. And so as we look at these various stress tests, I am comfortable that they adequately prepare the company to think through how would we react to these market events. Just yesterday, I think it was yesterday, we released the scenarios we're looking at in conjunction with the Fed and the OCC for the stress tests. And we constantly try to improve and work on these models, but the biggest one, again, is I think CCAR, and for that it will be the Federal Reserve question, and how comfortable are they with their models. They keep their models pretty secret.
We've got some very large, complex financial institutions that are not banks, namely central counterparties. How do you feel about your role in resolving a failing or failed CCP?
Yeah, so Dodd-Frank is a really interesting piece of work sometimes. And here's one of those scenarios where you're like, what do I do with this? So CCPs are not regulated by the FDIC.
Correct.
They're not insured depositories, so we just don't regulate them. And yet, we're supposed to resolve them. So somehow we're supposed to resolve the entities that we're not regulating. And so when I came to the FDIC, I said, how exactly do we do that? Because, and here's why that question is important. If you regulate an entity, you ask me, how do we look at a failing bank and how do we resolve a failing bank, right? Months of monitoring, months of looking at liquidity and capital. If they get on a problem bank list, we know to monitor them even more. Every day they report to us, their capital standing and liquidity. If we need to sell them, we know what's under the hood, right? And so with CCPs, CFTC knows what's under the hood. I don't know what's under the hood. So we have engaged with, we have an ongoing work stream, but I actually called up the new chairman at CFTC, Chairman Tarbert, and I said, hey, can we talk about how we would resolve this? So that work is ongoing. Just figuring out exactly what triggers we would put in place. At which point they stop being his headache and they become mine, right? At which point CFTC is taking the backseat to the FDIC coming in and trying to resolve it. And so I think we need to do quite a bit more work in that area, and that's something that we engage with the CFTC on making sure we have at least a roadmap, and hopefully never have to test it, but at least we have a roadmap.
Great. Well, we've covered a lot of ground, and you've been very gracious in answering some pretty probing questions. I'm just trying to see here if we have time for one or two more. Well, here's one that make you chuckle. Should the FDIC be renamed the Federal Deposit Guarantee Corporation?
Ooh, I don't know, FDGC.
You don't have to comment on that.
You know how much money I have to spend on changing all the logos everywhere?
Yeah, exactly.
No, for that reason alone, no.
Great. Well, Jelena, this has been wonderful. I really appreciate your being here. Thank you so much for coming.
Thank you. Thank you all very much. Thank you.
And I hope everyone will join us for our next Fireside Chat, which is with another outstanding woman in finance, Laurie Logan, who is the EVP at the New York Fed and the manager of the System Open Market Account. In other words, she implements monetary policy. She's going to be here on March 3rd, so please join us for that meeting. Thanks a lot.
Thank you all.